Welcome back, everyone, to Vox Market Live. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to legendary UK fund manager Christopher Mills of Harwood Capital. So, welcome, Christopher.
Welcome, everybody.
It's great to have you back on the show. We've got tons of news coming through in the last few weeks, and we've got plenty more for the rest of January. Not least on Monday, we've got the inauguration of President Trump. We also have the start of the US earnings season this afternoon, and we've got a ton more of year-end trading updates. But putting all that together, what's your broad outlook for your sort of sweet spot of small and mid caps for the rest of the year?
Well, I'm afraid I think it's going to be a very tough year again. I think the government's got us in a real mess. Government borrowing costs are going to be much higher than they expected. So they're going to run out of money. One of their big things is housing, but if there isn't demand there to buy the houses, there's no point building them. And when you look at, say, the Vistry statement, which was really interesting the other day, I mean, we're not a shareholder in Vistry, but they were saying, A, private demand wasn't there, B, sales to partnerships was soft, and C, they had a lot of houses they couldn't sell because the bids they were getting for them were too low. So they were going to keep them on their book. So this theory that we're going to grow our economy by increasing, building 1.5 million houses in the current 5-year period of this parliament is just a fantasy. We'll be very lucky to exceed the Tories' achievement of last year. So
that was a bit lamentable, wasn't it?
Where the growth is coming from, and obviously UK small cap is also UK centric for a large part, and so the NI is going to hit. Minimum wage increases are going to hit, and yes, you'll probably try and put some through with extra pricing, but I don't think the consumer's feeling particularly buoyant at the moment, so increasing pricing is going to be difficult. And the hospitality sector, I mean, God help. The Chancellor sure hasn't.
They'll have to do the support people going out for having a meal again, won't they? They did in the pandemic. But the economy may be a bit sluggish. I think everybody sort of expects that. But the valuations are pretty compelling at the moment, and you're seeing that through a lot of M&A as companies have been taken out. So it might well be that you do get that slight disconnect between a sluggish economy and a better, more supportive small and mid cap, return.
We absolutely agree. There's going to be much continued M&A, continued lack of interest in IPOs. So the market, we think we're going to have a reasonably good year, to be truthful with you, but that's going to be M&A based rather than because we see the market as a whole going up.
Yeah.
And you've seen some pretty distressed selling recently. And the redemptions are still sitting there. Now, we're very lucky because all our funds are closed-end funds, so we get permanent capital. So we aren't forced sellers, but there's no doubt but over the last few weeks, the redemptions keep coming.
Yeah.
And what saved the market to some extent last year was there was a number of takeover bids, which were sufficiently large that the small cap fund managers could fund the redemptions out of takeover bids. But, you'll need to see a lot more coming in over the course of the current year.
Yeah.
And if you then look at the long-term implications of this, you've got a declining gene pool of investable companies, which isn't good for any of us.
Yeah. We may get a return of the IPO market. You never know. That would be.
No, and
that is clutching at straws. Yeah, that is clutching at straws. Okay, if anybody wants to ask Christopher any questions, please put them in the chat bot and I'll read them out. We've had a couple actually from a guy, professional investor Ben Sharman. First one is asked about Van Ellen. I know Christopher doesn't own it. I think it's one of his colleagues in the Harwood stable, Richard Staveley. So apologies, Ben, we're going to have to move on that one. But he does ask a second question about just broadly the investment trust sector and the sort of the large discounts in the in the current trusts, the Harwood Trust's net assets, essentially, the discount pricing.
Well, some of ours actually trade at premiums, but yes, North Atlantic and Oryx are at discounts.
Yes.
Ironically, one of the reasons we're discounts because we don't issue equity. It seems that the funds that are issuing new equity get more interest from the brokers. And in North Atlantic, as you'll have seen, we continue to buy the shares back because we just think they're the wrong price. And we'll continue to do so as and when free capital becomes available. But I think the problem, and we're trying to correct it in North Atlantic, is, we have these private companies, and we are now putting out announcements whenever we make a new investment in a private company, or we dispose of an investment in a private company. So we're very close to disposing now of Journey Group, which I'd hope to put an announcement out in the next 2 or 3 weeks, which will be a nice liquidity event for us. Obviously, we're working on 1 or 2 acquisitions as well. But it is a problem, but the trust over the years has made a huge amount of the money that's ever made investing in private companies. And certainly, one of the last ones we just did, which was Crest, is one of the most exciting deals we've ever done in our lives. And over a 3-4 year period, we'd expect to make, 10, 20, 30 million off this thing. Not least of all because since we bought it, it has successfully won another. We bought it when it was doing about $16 million of EBITDA. It's now won 2 new contracts, which will add $6 to $7 million to that, at a capital expenditure of less than 10 million, and they're both 5-year contracts. So, and it's a food ingredients business and a food manufacturing business. And as you know, people pay very big prices for food ingredients companies, as you saw with Tate and Lyle the other day. I think they paid 14 or 15 times. And we bought this thing at about 6 times, falling to 4.
So effectively, the discount is just a temporary thing. Eventually, the value will come out, and it will become the NAV will keep going.
I can't say the discount is a temporary thing, but what I do believe is if we're more transparent, that will help. We are now doing quarterly presentations, every 6 months, one on North Atlantic, and every 6 months, one on Oryx, and we're doing 1 per quarter, obviously. And I think looking at the Oryx portfolio in particular, I would expect there to be quite a lot of takeovers in that portfolio. And oops, I've got something going wrong here. Can you see me still?
Yeah, and I can hear you and see you fine.
Okay, because I'm running across my screen's a blue line saying low disk space.
Oh wow, okay. Hopefully we're fine. You're fine at the moment. Let's keep going while we can.
Okay, I got rid of it anyway. Okay. So no, we're quite excited about the portfolio. We believe that it's kind of discounts on discounts, isn't it? Because if you're investing in companies which we believe are trading at discounts to their private market value, and then you're trading at a discount to your value. And hopefully when we start talking about some of the stocks, it'll become more obvious as to some of the potential upsides we see in those investments.
Well, you never know, Christopher. You may get an activist investor on your share register, get Sabre coming in, who rattle them a bit.
Well, I'm not so sure they'll enjoy that.
No, I don't think they'll be very successful either. Okay, good. We've got a couple of questions. Steve Walters and Paul are both asking about Spire Healthcare, which is the UK's largest private healthcare operator. The UK, as probably as people know, is we've got massive waiting lists on the NHS, 7.5 million. And I think actually I read somewhere the Spire is actually in partnership with the NHS now to try and to reduce those. How are you seeing the Spire Healthcare business progressing?
Well, I mean, our view is the whole thing's just silly at the moment, the share price. If you basically keep it simple, they've got property in there, freehold properties of 1.2 billion. The debt, give or take 300 million, and the market caps, give or take 900 million. The EBITDA is just shy, well, it'll be more than 300 million this year. If you knock off about 80 million of EBITDA for the lease properties, takes you to 220. Knock off, shall we say, 70 or 80 million for rental on the properties, they're freehold properties. Then you're still left with, call it 140 million of EBITDA. You know, the last transaction that was done for a hospital management business without properties was done at about 6.7 times, I think. So you've got nearly $1 billion of value in there, or twice the share price sitting there for nothing.
Yeah.
The debt's due to come down fast. The P's due by the end of 26, I think debt will be down to about 130 million. The dividends rising. They've started to buy back shares, and you know they've got this large South African holder, who owns 30% of the company, and you know our understanding is that they would not be adverse to seeing a bid for the company. And indeed, over Christmas, there was an Indian hospital management company who said they intended to speak to the large shareholders to see if, you know, if they were interested in a transaction. So you've got a really cheap stock, you've got a catalyst, and it looks like you might even have a potential buyer.
That sounds like a perfect mix. Just in terms of the increasing NI for the employers coming in April, is that going to be a pass-through cost for the NHS when they come to sort of like, you know, for the pricing?
Well, I mean, it's kind of bound to be, because the NHS aren't using them because they want to use them. They're using them because they have to use them.
Yeah, okay. Yeah.
And I mean, for what it's worth too, you know, we think the earnings per share go from about 9p this year to, you know, only 20p a share within a couple of years.
Wow.
So, you know, it stacks up on everything. It's cheap. It's paying down debt at the rate of about 70, 80 million a year.
Yeah.
It's well managed. You know, instead of just taking on everybody or anything, they're now managing their business to maximize profit per square foot. So they're doing less cosmetic surgeries, more hips and knees.
Yeah.
So, you know, that's one of the big things that they talk about, because they came out with this 75 million cost-cutting program, which they've just seen the first year of.
Yeah.
And that's a 3-year program going into 2026. And that's obviously driving quite a lot of the profitability growth as well. Yeah. But I mean, if you think about it, it's pretty obvious. Why do cosmetic surgery, we're not making very much, when the same, you know, ward and same surgery could be used for more valuable, more revenue producing operations? Yeah.
No, I mean, it looks a great combination. It can pass through its cost. It's got pricing power, and the demand is going up. So it seems to be well positioned. Now, in the same sector, we've got another company which does occupational healthcare called Optima Health. It basically was spun out from Marlowe, and I saw that it sort of dropped onto your portfolio holdings just of late. How do you see this one?
Well, we were a shareholder in Marlowe. I think the real key to understanding this is the stock is £1.40 at the moment. At the time of the IPO, management bought in £2 million of shares at £2.50.
Wow.
Their entire incentive scheme is around getting the share price to £2.50 over 3 years. And frankly, we think that's eminently doable. The company was given no debt. Its EBITDA is not expected to grow rapidly between now and 2027, but probably to 18 to 20 million. They do have an NI problem, obviously. But you've got a market cap of 126 million. By the end of 27, we think the cash will be 20 million. And they basically said one of the justifications that they were prepared to pay 15 times EBITDA was because that's what they believe the business is worth at its private market value.
Right.
So if you basically said 15 times 20 takes you to 300 plus the cash 320, current market cap's 125 million. You know, you're looking at comfortably more than a double over 3 years if they pull it off. Yeah. They don't have to pull very much off.
Yeah. Is that just a multiple expansion though? If the EBITDA doesn't go up, then it's because, you know, the competition. It's basically an arbitrage of the current public sector valuation.
You know, when it IPO'd, it was trading, you know, well into £2 for a few minutes.
Right.
And just, you know, it became an orphan stock, small cap. You know, if you had a position in Marlowe, you now had a quarter of a position in Optima. So people said, you know, what's this?
Right.
Threw it out. But the interesting thing is that Michael Ashcroft also has been buying a ton of shares.
Right.
And he knows the agenda, right? He's the biggest shareholder already. He's the biggest shareholder in Marlowe. He's on the board of Marlowe. And as I said, my understanding is from talking to the management, they very much see this as, you know, a 3-year deal where they hope to get rich by getting a share price up, as I said, to at least twice where we are today. Yeah. And again, you've got no debt in the company. It's nicely cash generative. So you're looking probably at 10 million of free cash a year. You know, they'll try and find some small acquisitions, which would be also accretive, but they obviously have the money to do them because they've got this debt-free balance sheet.
Yeah. Okay, good. Just moving now to another company in that same sector. We've got a very popular one. Simons is asking about it. EKF Diagnostics. Now, I know you're on the board here, Christopher. So we've got
last year. So I think the answer is that the issues that the company had have now been largely resolved, with Julian Baines coming back effective chief executive. The company has no debt, approximately, say, 15 million in cash at the moment. We've definitely had a good year last year, but I think going forward, people should remember that this company is very exposed to the US dollar, which is good news for us. Some of our products are doing well, some are doing less well, but we're very cash generative now. And the real key is seeing if we can get the South Bend plant, which is sort of in our life sciences division, getting more throughput through that facility, because the margins in that plant are very high indeed, but making these enzymes is not easy. And we need to strengthen the sales team there as well. But if we could put another 5 or 10 million pounds extra of volume through that plant, and we could, that would have a very meaningful impact on our earnings. And there's absolutely no reason to believe that we won't have further earnings growth in the current year. So, one of the things the board will be thinking about is, if we're generating all this cash, what to do with it. And that is something we're talking about at the moment.
Yeah, I know the exec chairman Julian Baines is he's very, very talented, but he has gone plural now. Isn't he doing the exec chairman job at Renalytics as well? And I was just wondering.
Yes, he has. Yes, he is.
He's a bit like Elon Musk here, multiple. So is he? Given it, obviously, Renalytics has got plenty on its plate, and there's a turnaround on the fermentation. Has he got enough bandwidth there, or does he need a few more sort of like troops he can help the?
Well, we have good troops in the team now, so that's been done. But there's no question we need to put more effort into getting the enzyme business right.
Yeah, okay.
Because getting it right would be transformational.
Yes, exactly. Yeah.
So we've got the plant, so the capex is behind us. As I said, the business is very cash generative. If you look at what's happened over the last year, there's no reason why it won't continue to be very cash generative. And our market cap's only about 110 million pounds now. So strip out the cash, takes you 95 million. If you take market estimates for last year, this year, this is trading at a very low multiple of EBITDA.
Yeah, I know that core diagnostics business, the point of care for blood, is fantastic. No doubt about it. Okay, good.
Particularly in hemoglobin, where we are now, we might be number 1 in the world, but we're definitely number 2 in the world.
Yeah, Good. Okay, another one which has got fabulous diagnostics, point of care, is NIOX. And you've obviously highlighted this to investors when it was only about 20, 25p. Currently trades about 60, having given some money back in a tender offer at 80p. How are you seeing the growth trajectory of this business going forward?
Well, it's doing very, very well. I mean, the advantage of NIOX that NIOX has got is that it is, in fact, the absolute dominant world leader. And you're seeing more and more medical publications talking about the need to read the nitrogen in people's breath, which enables you to determine how much steroid you will use for these deeply asthmatic people, because as we all know, the last thing you want to do is take too many steroids. There really is no competition. The challenge the company has, because it's still relatively small, is breaking into the US marketplace without having to spend a fortune on creating a US marketing team. But the company is very cash generative. It's still growing very nicely. I would guess they're throwing off now 15, 16 million a year in free cash.
Yeah. Because
remember, courtesy of Mr. Woodford, this thing has 600 million tax loss carry forward.
Yes.
So, I'm sure the dividends will continue, and I would guess there's a possibility that there'll be further tender offers. Yeah.
Okay. Good. And then in the States, do they need FDA approval at all, or is it really just they need the sales force?
They've got all the approvals. It's just just breaking into a new market.
Yeah. Okay.
And obviously the US market's huge. Yeah. But there again, certain markets which you wouldn't realize are going gangbusters, like Japan.
Yeah, out in Asia. Okay, good. We got another question.
There's no mathematics out there, I can tell you that.
Yeah. Okay, we've got another question coming in for another stock that's done really well for you, Christopher. He's got one question from Steve Waters. He's asking about Pinewood Technologies, which is that sort of like cloud-based car dealer software management system that was spun out of Pendragon and has teamed up with, I think, is it Lithia Motors, I believe?
Yeah, that's correct. Okay, so this has been a big victory for us, but we think it could easily double again over the next 3 years. And in fact, we've been buying some stock to add to our position recently. What has happened since we last spoke is they won a major contract from Marshalls to roll out their software. And I think it's worth pointing out that they've still only got 4 of the 20 biggest dealerships in the United Kingdom. And one of their problems, very simplistically, was as long as it was owned by Pendragon, dealers were reluctant to use them. Now that problem has gone away. So they had a capital markets day the other day. They came out and said that their new target for 2027 was 30 million of EBITDA in the United Kingdom.
Right.
That is up from 27 million. So that's a nice increase. And it's our opinion that they'll probably be conservative when they come up with that number. And then we should not underestimate the US opportunity, which is the 51-49% joint venture with Lithia in the United States. Lithia is basically going to roll their software out over all their sites. That should produce somewhere in the region of $60 to $65 million of revenue, EBITDA of about 31, 32, 33. So let's just say they're 49%, 15 million, or another 12 million of EBITDA. So you're looking at a business with SaaS recurring revenues doing 42 million run rate by the end of 2027. And that's silly, because then you're looking at 7 times EBITDA for a rapidly growing business, and they've very much got plans to over the long term reduce Lithia's stake in the joint venture, but at the same time go out and try and find other big clients in the United States to put onto the platform. Because we still believe this is a best-in-class platform. They're investing in it. And to some extent, they got lucky about 4 or 5 months ago when their competitor's platform fell down completely. And all the dealers who were on it had to go back to basically Egyptian style accounting.
Yeah.
With those on the board.
Yeah, I mean, I'd agree with you. If they can do 40 million of EBIT, 40 million plus of EBITDA, then it should be a sort of 15, 20 times EBITDA multiple easily, and that takes you to round about 600 to 800 million.
Yeah, so 600 million. And by the way, by then too, they'll have quite a lot of cash on the balance sheet.
Yeah,
and they've got cash now, but that cash obviously builds quite fast.
Yeah. No, it looks a good one. Another one which is in sort of like SaaS software that has gone through a bit of trials and tribulations, got bid for, is in the student edtech sector. It's Tribal Group, which is a sort of like mainly 80% SaaS revenues, supplying sort of like student information systems into universities in the UK, Australasia, and a bit out in Asia, but also got 20% in its edtech services. How are you seeing this one? Because the shares have fallen after getting a strong 74p bid about a year ago.
Okay, so what's going on in there's what's going on in Tribal and then what's going on with the shares, because they're kind of different things. Tribal is in a sort of transition period where it's just introducing its new admission software, which they intend to bundle with all their other software, and that will both increase margins and accelerate that part of the business's growth. The problem is there's a bunch of legacy systems on the other side which are going in exactly the opposite direction. So while I think you'll see a more profitable Tribal sales growth will not be as exciting as we would hope. However, the admission software now being introduced will mean that the amount of capitalized expense will come down very significantly, and the business should be significantly more cash generative than it has been in the past. They settled the lawsuit in Singapore, which is other good news. The problem with what's going on in the share price is, as you said, there was a 74p bid. The problem is that the person who made the bid competes against the man who happens to own 29% of the company, and he's determined that they're not going to get this company. So that creates a problem in its own right. Now, there is a way around it where they could go around and sell all the assets, and that's something that we're urging them to consider them to do. And we're not alone in that. There's other big shareholders, English shareholders, who basically want to see this thing sorted out, because there's no reason why this thing isn't worth 74p. The problem we've got with the American who's got the 29% is he's in the middle of a nasty divorce. His wife doesn't want him to bid for the company. He probably would like to bid for the company, but probably can't do it without her permission. So the whole thing's just frankly a mess.
Wow. Yeah.
So the company's getting better, more profitable. It still could do quite a lot to improve its margins, which frankly I think in our opinion are too low. But you've got this difficult situation between the American who, if he could sort out his divorce, he probably would bid. Or if she wins the war and he hasn't got the money, she'd probably sell.
Yeah.
So, in fact, we believe absolutely she would sell because she never wanted to make the investment in the first place.
Yeah. Yeah, I saw a similar situation with Pilot Media a few years ago, probably about 6 or 7, and they had 2 big shareholders who hated each other. And then after 2 years, they'd made up and they got married, and then they decided, they stopped throwing rocks at one another, and then it got taken off. So I think it will resolve at some point.
Yes, it will resolve at some point.
Yeah. Okay.
And I mean, the trouble is, of course, he's got to raise money to pay her off, or she remains a shareholder in the company, and it's just a mess.
Yeah. Yeah. Okay, good. Let's move to another one. We've got interdealer broker TP ICAP, which has done really well actually. Obviously it does a lot of sort of professional sort of like trading off market services in energy, interest rates, currencies and stuff. But it's also got this crown jewel Parameta that you've talked about. They're trying to spin off, and I did hear a whisper that they're thinking about listing it on NASDAQ as well. How are you seeing this monetization sort of like program continuing?
Okay, well, I think if you just look at the core business, first thing to remember is that 60% of their revenues are in dollars, but only 40% of their expenses in dollars. So they're a major beneficiary of sterling weakness. The second thing is that they're a major beneficiary also of bond volatility. So the core DB business should be doing well. Parameta, which is basically an information database, continues to grow very nicely indeed. And yes, we've had the same rumors that they're considering floating that on NASDAQ. And if you say, I think EBITDA in Parameta is about 110 million this year, pounds.
Yeah.
You know, if you got conservatively 12.5 times, I think that'd be disappointing. You know, that's covering a huge amount of the market cap of TP ICAP.
Yeah.
And so the rest of the business will be sitting there on a P of 4 or 5. Now you could argue it shouldn't be much more than that, but it also comes with obviously a very good dividend yield. And then the other interesting thing is that they bought a company called LiquidNet. Well, I would argue at the wrong price. But now LiquidNet is starting to do really well. And, you know, if it gets back to anything like as valuable as what they paid for it, which is about 550 million pounds, you know, those two assets alone cover the whole market cap.
Yeah.
And of course, they're buying back stock at the moment. You know, good question. What will they do with some of the proceeds they get from, you know, selling part of Parameta? Going to stop buyback, special dividends. So we still see there's further upside in this, although in all fairness, the stock has really doubled since we started buying it.
Yeah. No, it was a good one. You flagged a couple of years, Bo, and I made some money on the back of it. So big thanks for that, Christopher. We've got a couple of
10% dividend yield too.
We've got a couple of questions. One from Paul and another one from Patrick asking about Avingtrans, which is basically it's a specialist niche engineering business that focuses on regulated industries like nuclear and transport and energy, doing things like blast-proof doors and safety boxes for Sellafield low-level nuclear waste and sort of like high-performance pumps and stuff. And it's also got a medical business as well. How are you seeing this one progressing?
Well, the stock has actually been rather disappointing over the last year. It's just done nothing. But actually, the businesses have done really well. It's always frustrating, but I suppose in a small cap with limited liquidity, that's always going to be the case. I think it's worth remember that, you know, they have what they call a PI program.
Yeah.
Purchase, improve, and exit. So, you know, we would hope to see them exit, you know, 1 or 2 businesses over the course of the next 18 months, hopefully resulting in returning capital. Our private market value for the, let's say, operating businesses, you know, is comfortably in excess of £5 a share.
Yeah.
And, you know, there's all sorts of estimates as to what medical could be worth. You know, I've seen some estimate as much as £3, £4, £5 a share. But we kind of, you know, don't really count that into our thinking. So, you know, our interest in the company, and I think we're their largest shareholder, outside shareholder, is all around them being able to buy good assets, improve them and sell them. And they've been remarkably successful at doing it. And if the economy is going to get a weeny bit worse, hopefully they'll be able to find some more bargains to do it again, because the last business they bought, they basically bought it for nothing. Now it'll lose a little bit of money before they turn it. They bought the nuclear door business virtually for nothing, and that's now making, I think, 1 or 2 million, probably worth 12 or 13. So really good management team that we like a lot. Obviously, we know them very well, and obviously with Roger McDowell, who we obviously have a close relationship with, being the chairman there, we're feeling very comfortable about our investment.
Yeah, I remember interviewing Judith McKenzie from Downing, and I think she was on one of the other sides of she was the selling shareholder to both the Steves, the CEO and the CFO at one transaction, and I think it was quite a painful process because they've turned the business around and it really has shown value, hasn't it?
Yes. No, I mean, they really know what they're doing, and we just think they're really good guys.
Yeah.
And again, you've got a company. I think it's important. All the companies we've been discussing so far, very, very little debt.
Yes.
So something like TP ICAP has debt, but it also has huge cash balances.
Yeah.
So it's actually got net cash. Avingtrans has very little debt. Spire obviously has debt, but it's coming down very rapidly. And the actual debt's only 1.5 times EBITDA, which for a company stuffed full of property is hardly going much.
Yeah. Good. Okay, right. We've got a question coming in from, I think it was Mark. He's asking about, here we go. Let me put it on. He's basically, he's asking about facilities of ADF. And he noticed that you acquired a stake in the placing in October. There was then a disappointing profit warning, and he's wondering what's your sort of confidence and your view of the business going forward?
Well, this has obviously been a mistake.
Yeah.
We are less than amused, to be truthful, about the warning. We believe the business is a fundamentally sound business, because every indication is that there's going to be more and more films and TV programs made in the United Kingdom. They have got leading market positions in what they do. They should have, in my opinion, known that it was going to take a bit longer for the revenues to come back, but that doesn't mean it isn't fundamentally a good business. And I suppose we're definitely not going to sell it. We're thinking as to whether this is the time to average down. So that's something that we're discussing at the moment. Although, in all fairness, until the money comes in from Echo, which ends at the end of this month, and also GYG's been taken over, and that money arrives in about 3 days to 4 days, 5 days time. We're a bit short of cash at the moment.
Yeah, I mean, what would trigger you to effectively buy it, or not double down, but buy lower in terms of, because the market seems to be the trading update seemed to imply that there was still feeling the after effects of the Hollywood writers and actors strike that had led to less sort of like outside production of films and
well, unquestionably it did, and we knew about that.
Yeah.
In fact, the whole market's known about that for some time.
Yeah.
It was, we were given the impression that, we were now heading back to normal. And clearly that wasn't quite right. Yeah.
You'd think it was a temporary effect, though, as in, like, there might still be sort of like, little tremors, but it should be cleared off, I would have thought, fairly soon.
It's definitely a temporary effect, for sure, because there's these huge new studios being built in England. I don't know whether you go down the M4, but there's a monumentally big one that's just been built there.
Yeah.
And again, with England's a relatively cheap place to produce these programs, and there's lots of government incentives to do these programs. So I'm 100% sure it'll come back. It's just really annoying to be caught out, shall we say.
Join the club, Christopher. I spent my life getting caught out. Okay, right. Let's move to another one in the engineering sector. We've got Trifast, which does sort of like industrialized specialist fastenings for moving to more high performance sort of applications and stuff. Going through a bit of a turnaround at the moment, but the shares seem to be responding reasonably well. How do you see this one transitioning?
Okay, well, obviously we've got Nick Mills on the board. So we obviously have some idea what's going on in the company. Around the current share price, the enterprise value is about 130 million. And I think brokers' forecasts to the end of March are around about 21 million.
Yes.
And a profit before tax about 10. So the real key here is we believe this company should have margins of 10%. At the moment, the margins are 5%.
Yeah.
So if we can get it back to 10%, and that is very much where the management's hoping to do it, because their incentive plan, I think from memory, they've got to get the share price to 140. It's not less than that. So if you basically said you go to a 10% margin, and you're looking at 8-9 times EBITDA, say 9, and 1 time sales, and you've got a stock that could nearly double from here again. And we're obviously impressed with the management team. So far, we think they've done a very good job, and we think that it's more of a global business than say a Flowtech. And they've slightly got more interesting product. So I think that the target of a 10% margin is achievable. It's been done in the past. Apparently they've been reviewing all their customers, and they're working out some customers they didn't make any money with. So just getting rid of them is a good start, isn't it?
Yeah. Would they be impacted at all by sort of like possible incoming trade tariffs by Donald Trump out in the States? Because that could sort of like change a lot of supply chains. I mean, I've got no idea.
I don't know the answer to that.
Yeah. Okay.
Sadly, Nicholas is at a wedding. Otherwise, he'd be here with us, and he could answer that one for you.
Okay, good. Let's move to another company that's got very good margins actually, and doing a terrific job is PayPoint, which does the sort of the ATMs in convenience stores and allows people to pay bills, and is now moving also into allowing people to drop off online packages and send them off and stuff like this one. Trades are only about 10 times PE, paying a good 5.5% dividend yield.
Well, even more now, because stocks come back a bit.
Oh, okay.
It's about 6 now.
Yeah, okay.
I mean, look, the story is they came up and they said, we can grow our EBITDA over the next couple of years from about 80 to 100 million. And they certainly look on track to achieve that. The exciting part of this business is tied to parcels, which are very profitable. And as you see more of these post offices close down, people put the parcels somewhere. The second thing is they're entering into agreements with banks where, as you know, banks are closing their branches down. So again, they're going to be providing deposit taking and just a limited amount of handing out cash to banking customers. So that's a very interesting partnership. The company's basically said that it's not going to grow the dividend as fast as it has in the past, but use the excess cash to buy back shares, which they're now doing. I have no idea why the share price has come down so much in the last sort of month. I suppose it's just there's a whacking great seller out there. I don't know. But certainly when their last public announcement was significantly in excess of our expectations. So the business is doing well. And when you talk to management, they believe they could probably double the share price from here over the next 3 to 4 years. In fact, they actually say they could even do better than that.
Yeah. Now you raise a really good point actually with that old ATM business in particular. They could be the only game in town because the banks are not only shutting branches, but they're shutting ATMs as well, aren't they? So if people want to get cash, which actually seems to be the case at the moment, there's more cash usage in circulation, then there's going to be fewer options for them to get it actually.
Absolutely. And I mean, we were lucky because a lot of our position, we had a stake in a thing called Appreciate, which they took over. Yeah. So our average purchase price here is about £4. Yeah. So we were getting really quite excited. But no, it's still very much a core holding. And actually, we will continue to chip away at buying a few more over the next few weeks.
No, it looks to be good. Okay, let's move to fund managers. Obviously, an area that you've got a great deal of expertise in. Let's go to Polar Capital, which is more of a sort of like it's an active tech focused investor in sort of like
it's tech, medical, and insurance and financial.
Yeah.
I mean, Polar is. I know it's a pretty grim market for UK fund managers, but at least they're managing to grow their assets under management.
Yeah.
The way we kind of see it is it gives us exposure to things that we don't naturally have because we're not big technology investors, as you know, and we wouldn't necessarily invest in big cap pharma either. Obviously, they are dollar centric in their assets, so the weakness in sterling will help them. They just came in with some much better than expected numbers on performance fees, so they made another 9 million more than people were expecting. So the way we see it is you've got a dividend yield of nearly 10%, 9.5, which is sustainable. We still think Gavin Rogerson is an outstandingly good chief executive. And we actually think of all the active fund managers, they are probably best placed in the market at this moment of time. So we're still very definite, still strong holders of Polar.
Yeah, they pay a 9% dividend yield as well, don't they?
Yeah, you get paid to wait here.
That's crazy. 9%, flipping hell. Okay.
Well, a lot of the fund managers pay big dividends, but you know, people are expecting both Lion Trust and Jupiter to cut theirs at some stage.
Yeah. Where
there's no indication that Polar's even remotely thinking of that. You know, Premier Miton did cut its dividend a few years ago.
Yeah.
So, you know, these people actually have growing funds under management as opposed to mass redemptions.
Yeah. Okay, good. We've got another one in the fund manager sector. We've got a question coming from George. He's asking about latest update on the spin-off at AssetCo of their Parmenion stake.
Well, obviously, I'm on the board of this, so I know what's going on.
Yeah, okay.
The company is absolutely committed to distributing the Parmenion stake to shareholders in a form that when Parmenion ultimately gets sold, the shareholders will get all those proceeds.
Yeah.
I have to say, I just think the whole thing, the AssetCo share price is just stupid.
Yeah.
If we had an independent valuation from Hanneman Partners, which valued Parmenion at between 75 and 90 million. Now, you should remember that of that, 28 million approximately is in a loan note, PIK loan note. So 20p a share of AssetCo is kind of almost a first charge on Parmenion's profitability. Then at the 78 million valuation, the 25% fully diluted interest is worth another 50 million. So you could argue at the low end of the Hannon valuation, Parmenion alone is worth 52p a share. And then what's 3 and a bit billion under management worth? And a bit of cash.
Yeah.
I mean, if you said 14 million, that's 0.5% of funds under management. You know, we'd all agree that's pretty low.
Yeah.
And that's another 10p a share.
Yeah.
And, you know, the board is very determined that the shareholders should fully benefit from Parmenion when it's ultimately sold. And Parmenion is a really good business and it's growing very nicely.
Yeah. Well, certainly with yourself on the board and Martin Gilbert, also the exec chairman, you couldn't get two better minds in the fund manager space to realise some upside there. You would hope.
Well, we haven't done as well as I'd have liked so far, but you know, we're very conscious that we need to build value for shareholders, and that's why we're giving Parmenion away.
Yeah, well, I think investors are pretty patient. Okay, right. Let's move to another one in that sector, more specialist actually. That is Frenkel Topping, which basically does. It helps legal advice and also fund management for serious injuries in sort of like from the NHS and from just car crashes and this sort of stuff. So it's really helping vulnerable people, manages their money, gives them a financial advice and extra sort of services. The shares likewise have come down. How you see this one going forward?
Okay, well, I mean, Frenkel obviously has a national insurance problem.
Yeah.
And that's, you just can't increase pricing to offset that so easily.
Yeah.
So if we look at it, as you said, what the company looks after people who've suffered severe trauma and clinical negligence. And those are good marketplaces. So this is a backward integrated fund management group. So the fund management side continues to grow very nicely. Needless to say, the FCA turned up and did a customer review, and needless to say that cost us money, but not a lot. And the funds under management side has been growing very well indeed, really, really, really well. In fact, it's fair to say we're the only really real growth, organic growth IFA in the country. So that's gone well. The trick here is to ultimately increase our market share by having a touch point with the client through their whole SAD experience. So we start at the trauma centres, which has been a big victory for the NHS. For trauma centres, your chance of dying were about 80%. They're now down to 50% if you get into a trauma centre. We provide pastoral care in 10 of those, which is about a 40% market share. And we're way bigger than everybody else. Some of them are still managed by the NHS and some of them managed by ones and twos, not very well in our opinion. So in the trauma centre, you basically set up the legal panels. And so the legal panels we're starting to get to know the customer. Then you go to a costings company, which helps the client create all the services he will need or she will need to look after the disaster they face. So, if they've lost their legs, do they need a bungalow? Do they need 24-hour care? Do they need physiotherapy? So all of that, the costings companies work out with all these professional reports how much care this person is going to need. You then go on to, we have a long-term care management business which looks after them and makes sure they get the services. We don't provide the services, but we oversee that the services they need, they're being looked after. And then finally, we have a company which does witness reports, which helps identify how much cash they will need to see out the rest of their lives. Because if they need prosthetics, for example, you're going to need to change prosthetics. I'm making it up every 5 or 10 years. Yeah. Price of prosthetics is rising at 6% compound per annum or whatever it is. So you've got to make sure those people have enough cash to be able to cope with their life expectancy. The one slight negative we've had recently is there's a thing called the Ogden report. And the Ogden report sets the discount rate. And that makes a huge difference as to the amount of money someone's going to get paid. Right. So it's gone from negative to small positive. But, for someone who's 25 years old, 2% differential, 1.5% differential over 40 or 50 years has a big, big impact on the amount of money they would get. And that obviously impacts the amount of money that we can get. Yeah. But when we get in front of a client, our win rate at the moment is about 50%, which is extraordinarily good. Performance is very good. But the performance is not something that would interest someone like you, because we have to be much more conservative, because this person will never earn any money. Yeah. So it's not going to be NVIDIA and Microsoft, I'm afraid.
Yeah, I get it. It's only trading on 10 times PE, so it looks pretty cheap to me.
Yeah, it's certainly not expensive, and again, it's got a very good balance sheet. There's a weeny bit of debt and there's a weeny bit of earnout still, but all can be paid down with the free cash flow.
Okay, let's move to a couple of turnarounds. We've got cybersecurity specialist NCC, which has got a cybersecurity consultancy business and a software escrow division that probably has got unbundling opportunities between the two. The shares actually come back after selling off about a year ago. How do you see this one going forward?
Well, we like this a lot. In fact, we are literally buying shares as we speak.
Right. Okay.
Around about 138. The story here is really, really simple. AssetCo, which is the software, basically that business takes source software and stores it very cheaply. And if you've got someone's software, you can't afford that firm to disappear off the face of the earth. So you're going to happily pay the few £100 a year to know that your software is safe. So basically, it's a data storage business. All over the world, including sort of markets in the Middle East and India, governments are starting to say that financial services companies in particular must do this because they just can't take the risk of them going down. So this part of the business is growing very, very nicely indeed. At the moment, we're expecting EBITDA to be sort of £32 million in that business. And they sold a business last year for a very good price. So they've now got net about 20 million in cash.
Yeah.
So if they were to sell this business, I would be horrified if they didn't get 10 times for it, which was just another 25 million pounds. So that gives you £1 a share that can come back. And then you're left with a software business, cyber software business, trading at about 40p in the pound on sales, with a good management team who are turning it round. And there's no doubt they are turning it round. The recent decline in the share price was because they thought they were turning it around a bit faster than they are. But we have every confidence they know exactly what they're doing. It's one of Stuart's biggest holdings. In fact, I think it is Stuart's biggest holding.
Yeah, okay.
So we meet with the management very frequently. And as I said, they're very impressive. They know what they're doing and they understand that ultimately this thing's going to get broken up and there's going to be a shareholder maximization event.
Yeah.
And we would be really disappointed if we didn't get £2 a share and seeing some of that come back within the next 18 months.
Yeah. Okay, good. In a similar vein, we've got another turnaround. We've got Restore, which basically does physical document archiving underground for a lot of the government sort of stuff, and presumably strictly security stuff like that, or confidential. And then also does digital documents, sort of like destruction and all this sort of safekeeping and stuff. Again, coming through a turnaround. How do you see this one?
Well, I think this one's sort of kind of past the turnaround stage.
Yeah, okay.
Basically, they brought back the old management team.
Yep.
Who did a really good job, Charles Skinner, and he believes he can get the earnings per share up to between 25 and 30p over the next 3 to 4 years. And historically, this company has traded well over 12, 14 times, because the core business, which does about 40 million of EBITDA, is very recurring business. When he left, I think the statistics were there were 7 people in head office. When he returned, there were 57. I think they're now back to about 15, but perhaps even fewer. This is absolutely on our list again to continue buying. Stock's about 221, 22 today, which is market cap about 300 million. We think the private market value of this business is very close to £4 even today. And it's quite interesting that Charles Skinner himself, who was already a big shareholder, was buying stock recently at £2.80. So he didn't need to buy the shares. He's already a major shareholder. So I doubt he bought them thinking he'd lose that much money that quickly.
Yeah. Okay, good. Let's go through this. Finish on a couple of special situations. First of all, we've got real estate investors, which we rarely look at, but I found out that it's actually very close to my own heart, given that I'm based in Birmingham. It's basically a commercial real estate business that, as a landlord, invests in offices and all kinds of industrial premises and stuff in the Midlands. So I'm delighted to see it trading at a big discount to net assets.
Yeah, I think everything in the property world trades at discount to net assets.
Yeah.
The investment logic here is it yields sort of 7-8%. It's in the public domain. It's being liquidated. They're selling off the small properties as we speak, and they hope to get themselves into sort of a net cash position probably by the end of this year.
Yeah.
My best guess is it'll probably liquidate somewhere between 45 and 50p.
Yeah.
So if you take 45p and 29p, that's 50% over 2 years plus a dividend. Means 25% IRR, and everyone's aligned because the chief executive is a big shareholder too. This was done, liquidation was done in consultation with all the big shareholders. And again, we just bought a few shares the other day at, I think, 29p.
Yeah, no, it looks a pretty safe, almost bankable return. Not quite, nothing's bankable in this game, but if that one is, then that's sorry. So if there is one, then that's it. Okay, let's move to a final one. Again, we've talked about it. Hargreaves Services. It's got 3 divisions: a sort of land development, a sort of contracting business, and then it's also got a sort of like I think it's a joint venture overseas, commodities, sort of like renewables and this sort of stuff. How do you see this one?
The overseas joint venture is complicated because
the
actual economic ownership is very much bigger than the share ownership, because they wanted to keep the debt off the balance sheet.
Okay.
So that the overseas business is now recovering. It had a tough time. Longer term, it's going to be a beneficiary of some new legislation coming into play in Europe and ultimately the United Kingdom, which basically means if you import things like pig iron, you're going to have to put up a carbon credit to do that. As to how much of a carbon credit is, let's say, being debated very strongly in Germany, because obviously it impacts their car industry.
Yeah.
But that will just be pure extra profit for the company. So it's pig iron basically and zinc, and also commodity trading in Germany, and that's been historically a very profitable business. The UK businesses are doing really well, and helped, I'm afraid, by the fact that all of us are paying quite a lot more money for HS2 than we intended to.
And they
made a contract on HS2, which is obviously lasting longer. But looking further out, there's going to be 2 major reservoirs built, and these are big contracts. I mean, £billion-pound contracts, and there aren't many companies in the United Kingdom that can actually do contracts of that size, with all the ESG requirements that are expected as well. So they certainly expect to pick up a lot of work from those contracts. They got a big contract also recently for Sellafield. So I think the businesses are doing well. A big victory that happened over the last 12 months was they got rid of their pension deficit for a very modest amount of money. So when we first invested, I think the deficit was going to cost about 45 million to get rid of it. I think they got rid of it for 7 or 8 million.
Wow.
So that's a really nightmare off the balance sheet. The company's got no debt. Think about 15-20 million in cash. They've increased the dividend to 36 pence per share, which is fully covered. And basically, this is a business that we expect to ultimately be broken up, and value maximized. They have an asset that's on their balance sheet for very little, which is all this land in Scotland, which is having wind farms put on it and battery storage places put on it. And they basically said they intend to monetize that and return that capital to the shareholders when they do. And that could be very substantial.
Yeah, no, it pays a 6% dividend yield as well, doesn't it? So whilst that monetization happens, you're picking up a nice income stream.
Well, exactly, but they've still got all that cash sitting there, and the cash is building all the time.
Yeah.
All the debt you see on the balance sheet is leases tied to the HS2 contract, where they leased all the equipment. Now, ultimately, at the end of the leases, they get that equipment back for free. So there'll be some residual value going forward. And obviously, if they start to win, these big reservoir contracts, now they won't be a sole source for these big reservoir contracts because they're way too big. But their contracts could easily be worth 100 to 200 million pounds for them on each of them. Yeah.
Well, we certainly don't. We don't need another reservoir on the West Coast, I can tell you, because in Birmingham it's been tipping down with rain for the last 2 years.
Well, I think the earthworks alone for the big one near London is going to be about 3 billion to put it in context.
Wow, crikey! I'd never appreciated. Yeah, I know there are lots of infrastructure, but I hadn't appreciated we're now restarting the reservoirs. We need them. Okay,
we have no choice. We haven't built one for years.
Yeah, you're probably right. I've got a difficult final question for you here, Christopher. Putting all that together, we've gone through a lot of stocks and lots of questions and stuff. What's sort of the company and the stock that sort of like really gets the mill's blood sort of like excited for this year?
God, well, it's obviously something we'll be talking about. It's probably Spire.
Oh, okay, right.
Yeah, let me take a look. Well,
you did say that basically there could well be a natural event occurring over the next 12 months, given buyers and sellers.
And look, it's in the public domain because you could find it, where this Indian gentleman went on and basically said he wants to acquire the business or the majority of the business, which would mean you have to bid for everybody. And I don't frankly see a lot of downside in it because the business is doing well. We know the demand is sitting there. So, and the dividends are going to go up a lot. The earnings per share are going to go up a lot. I kind of see it as a one-way bet, really.
Yeah. Well, I think you've just made my father's day there because he's a big holder. He's followed you in on the Spire Health, so he'll probably top up his position now, having listened to this one.
Well, I'm very conscious that you're going to ask me how my stock did this time next year. So we don't want something that's going to go down the Swanee, do we?
No, exactly, yeah. Okay, well, thanks everyone for your questions. Big thanks, obviously, to Christopher for giving us his time and his insights. Absolutely terrific, and very much look forward in touching base again in 6 months' time.
Well, thank you very much indeed. Thank you, and Happy New Year, everybody.